Well, welcome back. Now we're going to start talking about financial accounting, and we'll be getting into our Libby textbook. This is on Chapter 1. It's PowerPoint 1. We're also going to have PowerPoint 1 exercises, where we'll be working through some exercises. After that, you'll be working on your Connect exercises, and the Connect exercises are due then tomorrow. Your next class period Tuesday at noon. So you'll need to get your Connect exercises done by noon tomorrow and submitted. The learning objectives are the things I put at the beginning of each one of our PowerPoints, and the PowerPoint learning objectives are the things you really must learn for this class. The first learning objective is understanding what financial accounting is and why you should study it. So what does it really provide us? Why is it of importance? The second learning objective is what is the output of financial reporting? What does financial reporting produce? And here I give you a bit of a clue, because the second question is what are the four primary reports? So financial reporting must produce an output which consists of four primary reports. The third learning objective is what are the financial statements elements, and how do we define these elements? It isn't just being able to come up with a definition for what the elements are. We also need to be able to classify things and to put things into their proper categories as elements. Fourth learning objective is the accounting equation. Sometimes this is called the accountant's equation. I think technically it should be called the accounting equation. This is a simple algebraic formula. You're adding two things together and coming up with a sum. And we will have some exercises which deal with this, some exercises which deal with learning objective 2, learning objective 3. The last is dual entry accounting and what it is. We're going to spend some time really on dual entry accounting in chapters 2 and 3, quite a bit of time on it. So this is really just an introduction to dual entry accounting. Financial accounting, first learning objective. It is the reporting of activities of an enterprise. Now, in our first PowerPoint, we talked about accountants and how accountants could work in business, nonprofits, and government. Well, here we are back to that again, because financial accounting is reporting within those. And it's reporting not internally to people inside the enterprise, but to external parties. So it's a type of communication. It's a communication to external parties. And what are we communicating? We are communicating financial results, financial information. And when we do this, there are some qualities or some characteristics we would like to see if financial accounting is done well. We need to have reporting that is relevant. It should help the reader make decisions. So we're providing a service. By providing this financial accounting, we are providing a service to the community of persons who are external and who want to look at our enterprise. It has to be relevant to help us make decisions. It has to be a faithful representation. A lot of big words there. What really we are saying is it tells the truth. It should be consistent, which means if we are going to file a report, and we said there's going to be 4 standard reports, if we are always preparing these reports, we need to do it in the same manner between time periods, so the person can look at a report in one time period, look at a report in another time period for the same enterprise, and make comparisons. And that's the next one, comparability. And when we mean comparability, it means that if we have 2 different enterprises and we want to compare these enterprises between time periods or between the 2 enterprises, we want to be able to make sure when we are talking about things, we are really saying the same things within those 2 different reports, because the reports are looking at 2 different companies. So consistency is between time periods and comparability is between companies. And lastly, very, very important, is the person who is reading it should be able to understand it. And one of the ways, as I've kind of hinted at it here, is that if we keep things in a way that is understandable, it means we are saying the same things. We are using the same words, and the words mean the same things, and no matter what company we are looking at. Why do we study this then? Well, it means that you can read it and you can understand it. And if you decide to go on and study accounting, you will be preparing reports. And so you're going to have to be able to prepare those reports and to communicate with others. And that would be your job if you were working in financial accounting. So if you study this, you'll have the ability to understand or read the reports that others are providing to you. And then if you decide to go into financial accounting, you will have that ability to communicate. Since financial accounting is showing up in all fields, my point 3 here is that these abilities will transcend into all fields. Again, if you like accounting, it pays well, as we learned from our introductory PowerPoint, and you'll have a high probability of finding work in accounting. The output, and as I hinted many times before, it relates back to these statements, and so we're going to jump right into talking about the statements. These are financial statements that need to be prepared by all the enterprises. The first statement, and some people argue this is the most important statement that can be produced, is the income statement. It shows revenues, expenses, and net income. And this is the success of the company over a period of 1 year or less. It is at least going to be done on an annual basis, but it could be done quarterly, it could be done monthly. It shows the inflows, which are the things coming into the company. We call these revenues. And the outflows are things that are going away from the company, which are expenses. And then the net of these two is net income, which is also called profit. The balance sheet is showing a condition of the company. It shows what the company has, what the company owes, and how it is funded. That is, how is the company able to come up with these things of value, which we'll later call assets. Assets minus liability is equity, which we will come back to later. Cash flow statements. Now, the cash that a company has is very important. Just like cash is very important to you. It's important for you to have cash because you're going to be able to have expenses, you're going to have things you're going to need to buy. So cash is important. Cash is also important to a business. A business that doesn't have cash and has cash shortages can't go out and make purchases and can't continue operating. So the cash flow statement is a statement that shows or reports information about how cash is moving within the company, how the cash is coming in, how it's going out, what's the balance in cash. The statement of stockholders' equity in your textbook will be calling this the statement of retained earnings, will show the change in the retained earnings account. And retained earnings we're going to define in a moment. So all of these 4 statements are done at least annually. For large companies, they're done quarterly, and for many companies, these will be done on a monthly basis. Income statement, balance sheet, cash flow, and statement of retained earnings. You have to memorize these. You have to memorize what goes into each one of these and be able to provide one given information. Here's your quiz question then. If you're interested in knowing how successful the company's operations were in the past year, which financial statement would we look at? So some of you will be able to answer this question without me putting up the options, and if you can, that's wonderful. Here are your options: balance sheet, income statement, stockholders' equity statement, or we are going to call it a statement of retained earnings, and cash flow statement. So which one of these talks about the company's operations, and it looks about success. Now success is also valued through profitability. I hope that's a little bit of a clue here. So the correct answer is B, the income statement, which shows inflows and outflows. Success is measured by net income, which is also called profit or earnings. Third learning objective, what are the elements? So now we're going to have elements, and we need to relate these elements back to the financial statements. On the income statement, revenues, expenses, net income. The balance sheet has assets, liability, and equity. The cash flow statements, and you will have one cash flow statement for every reporting time that you're going to prepare these, will have only one main account shown, and it is the cash account, and it'll just show the changes in the cash account. The retained earnings statement has beginning retained earnings, it has net income, it has dividends, and then it shows ending retained earnings. So within it, we are going to see three elements: retained earnings, which will have two balances, the beginning balance, the ending balance, net income, and dividends. Now let's talk about each one of these different elements. Assets, as I have up here at the right in the corner, assets are things of value to us. They are things that have meaning, they have value to us. We're quite proud that we have assets. Now the technical definition here are economic resources presently controlled by the company that are measurable value and are expected to benefit the company by producing cash inflows or reducing cash outflows in the future. Now, isn't it easier just for us to say that assets are things of value? Here are some things of value listed below. Cash. Of course, cash has value. We know that. Supplies. Supplies have value because we can use them. We can use them to produce net income. Our furniture, we need the furniture. It has value. Equipment has value. So these are things that you could think of in a tangible way, but you could also think of them in an intangible way. They are mainly things that have value to us. Liabilities are quite the opposite of assets because liabilities have value to others. Instead of just being proud of these things, we would really like to forget we have them. But we have to be truthful in talking about our company, because that's what we said in our financial reports. We need to be truthful. So we have to admit that we have these things which are owed to others. Oftentimes you'll see the word payable. Here we have a note payable, we have an account payable. It's common to see this terminology. The contra side to that, or the opposite side to that, is with assets, we don't have payables, we have what we call receivables, where people owe us. A payable is something that we owe to others. It's an IOU. The net of this is stockholders' equity. And sometimes we refer to this as the difference between total assets and total liabilities, and so we are going to call it net assets. The two primary accounts which I'd like for you to learn in this class are common stock and retained earnings. And you know that we are going to do this statement of retained earnings. So here we come back, and this is the same terminology, the same thing we are talking about when we talk about the statement of retained earnings or statement of stockholders' equity. Retained earnings then is the changes we have when we put in net income, we take out any dividends which are paid. Common stock is the money we get from people who choose to invest in our company. We sell them stock, and we record that stock, and we call it common stock, and so we keep track of it, and it becomes a part of stockholders' equity. When we have revenues, when we have expenses, the net of these is called net income, And this is really what's going to show up on our income statement. What are revenues? Where do revenues come from? Primarily from the sale of goods or services to customers. And we measure these by the amount of the business charges we impose on the customer. So if it were the sale of goods, it would be whatever that customer pays for us, net of any taxes they're paying, but what they're paying for that item. That is revenue. This is not cash. Okay, we're not talking about cash, because the customer could be paying for this thing not with cash. They could be putting it on their credit card. So we don't measure it by cash. We measure it by what is our sales. So our sales to customers is revenues. The other side we have is expenses. This is a necessary cost of doing business to earn revenues. That's our definition. We have to pay employees, we have advertising, we have insurance, we have utilities, and we're going to use up some of our supplies. I know we just said supplies were assets, but when supplies go away or we are using them up, this is a type of an expense. So expenses are outflows, but we can also use up assets and come up with expenses. This is a concept we're going to come back to in chapters 2 and 3. For now, I want you to know the revenues come about from sales. Expenses are the costs of doing business necessary to earn those revenues, and the net of revenues minus expenses is net income, which shows up on the income statement. The other item which we have as an element we need to talk about are dividends. Dividends are paybacks which go back to those who invest in our company. And because we have these dividends being paid out, they will reduce retained earnings. Retained earnings is going to go up by net income each time period, which is revenues minus expenses, or profit, and will also go down by the dividends, which is the profit which gets distributed back to these common stockholders. So now you can see retained earnings is changing. It changes over time, and how it changes. And retained earnings, we are going to show those changes in that statement of retained earnings. Dividends are not an expense. Dividends are a choice. A company chooses to pay dividends. Another quiz question. So now we're going to go back and we're going to start thinking about all those elements. If you had a car, what element is a car? And so start thinking about it. Is it a thing of value? Is it a thing owed to others? Is it a revenue? Is it an expense? Is it a dividend? Is it a net income? So think about what the elements are and then see if you can come up with what it is. What is it? Right. It is an asset. It's a thing of value, and we own it probably, so we call it our asset. Another one. If we owe the bank, which is, what is this? Right again. It is a liability. If your company sells something, what is that called? Right. It's revenue. If your company has to pay utilities, now think of this as utilities as a necessary thing that the company has to do to generate revenue. So what is that called? Expense. Now, the difference between the elements. Students here will often confuse assets and expenses. And so it is important to consider that if after you have it, after you've paid for this thing, if you have something of value, then it's an asset. For example, if you pay your utilities, once you pay your utilities, you don't really have anything. I mean, you've paid for the utilities after you've used your air conditioner all month long. You're going to pay your bill. You don't have anything to show for it, right? It's gone away. You've used it up. And you used it up in having a cool house, right? So that's an expense. On the other hand, if you're making payments and you're buying a car, you have the car. right? You have the car. That's an asset and not an expense. And cash is always an asset because it always has value. Liabilities and revenue. The good thing about revenue is it will always bring value to your company. Once you do the job and you expect to get paid for it, you call it revenue. Whereas liabilities are not something good. Liabilities is an outflow and something you'll have to pay in the future. This liability shows up where? On the balance sheet. Whereas revenue shows up where? Right, income statement. Learning objective 4, the accounting equation. All this does is describe what the balance sheet is. It's assets, liabilities, and equity. And we can define assets as being the total of liabilities, what we owe to creditors, or stockholders' equity. Now, stockholders' equity, again, we said was common stock retained earnings. When we call equity the difference between assets and liabilities, all we're doing here is rearranging this thing in an algebraic way. We're saying assets minus liabilities is equity, right? So it's just an algebra thing. Dual entry accounting means that whenever we do something in accounting, we are going to do something to at least 2 of the elements. This is something we're going to get into more in chapter 2 and 3. When we call this dual entry accounting, we have at least one debit, we have at least one credit. And the debits and the credits are going to turn out to be equal whenever we do something. So we're going to talk about this dual entry accounting. We're going to talk about transactions and how all this fits together. And this will be in chapters 2 and 3. Now, the next set of PowerPoints which we should be looking at will be PowerPoint 1 exercises. What we'll be doing is we will be applying the learning objectives to exercises. After we've completed that, you should be able to go into Connect, and you should be working through Connect and working through those exercises, which again are going to be due by noon of the next day. Okay, bye for now.